Morning. Yeah, boy! Once again, back is the incredible rhyme animal, the incredible D, Public Enemy #1. Good morning. What's up? Cold, quiet today. Oh, Friday already, huh? Thank goodness. So anyways, what is it time to go? Yeah, it's pretty close. Check this out. I'm about to get knocked out. Boo, boo, boo. So, one trade up here, the other trade here. So it'll be one break even and one for what? 25 or something. Boo. 30. So 5-0 said freeze and I got numb. Yeah. Can I tell them that I never really had a gun, but just a wax as a Terminator X spun? Yeah. No, they got me in a cell because my records they sell. Because a brother like me said, well. Yeah, Mr. Highvolt says, hey, looks like our trade plan. I asked you, did anyone take the trade? Anyways. At least you made map, yeah. Well, actually, technically, since if you cut the map in half, I made map on both. Right? So anyways, because it averages out to a map on both is what I did. So whatever. So I should be on the start screen. This is probably, right? It's just about 8 o'clock. So welcome to Forex.Today. Please leave a comment on the videos. Please click like. And please become a subscriber of our Forex trading community of almost 13,000 happy, shiny people. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Nice to meet you. I'm going to get the mic out of the way. Nice to meet you. My name is Wayne. I'm a currency trader. I've been trading currencies for quite some time. Before that, I was a venture capitalist. Before that, I was a successful entrepreneur. Before that, I worked at Apple Computers and Cisco Systems back when they were like tiny little companies. Before that, I worked at NASA. And that's about it. Oh, and I sat on a board of directors with George Soros before that. No, wait, that was after NASA. Anyways, whatever. Nice to meet you. Right now, I'm not only the leader of the Forex.Today community, but I'm also the chief market strategist for tradersway.com. And I am charged with the duties of helping you learn how to put strategies together and then trade them. See, to a broker, a successful, profitable, happy trader is the best customer you could possibly have, because they trade profitably for years and years and years, and they grow their account, and they grow their lot size, and they trade for decades. Need a little closer? Okay. So anyways, visit tradersway.com. Make sure you pay it back. If you like these webinars, if you like the fact I come to your life every single day, make sure you pay it back and thank Traders Way by opening an account. Tradersway.com. You can have an ECN account if you want. You can have a fixed spread account if you want. You can have a variable spread. Tradersway.com. Okay. Let us go now. We'll get back to here. This is just leftover from last night. By the way, anyone here, is anyone in the room right now from that attended last night's live trading group meeting? What'd you think? I thought about it all night. I thought it was fantastic. I thought it was really cool. I don't think we should do it every time, but maybe 60% of the time. All right, cool. Yeah, it was neat. Faux show. One of the best. Thank you, RC. Maida says, yeah, we should do it always. Yeah, I'm not saying no. Jim went in with trepidation, but it worked out. Yeah. Yeah, it's up there. It should be. I have to double check that the playlist is up there. But so what I've done is, instead of uploading a new file every time and have it archived, because now the archives are big, deep lists, I just, in the login room where you go to log in, now you'll see that there's a playlist video. Okay. Cool. Okay, so let's move on.com. Let's get off of this. Let's move. I gotta move. Give me the juice. La-di-da, la-di-da-di. We likes to party. That's funny. All right. Let us, I guess, just start with the typical scenario. What's up, Barry? Hey, do you like to cook? All right. Now, this is ridiculous here. This is ridiculous. Holy smokes. Okay? Holy smokes. Holy smokes. This is amazing. It's truly amazing. It's like 10-year T-note dropping below 1%. You know, just like never in a million years, right? Right? Never in a million years did I think that would happen. Yeah, Mr. Heivelt, things in the future are supposed to cost more because they have carrying costs, but if things in the future are less than they are now, that's contango. Gar, why don't you ask support? I'm sure they'll help you. Okay. All right, so Coolio. Just never in a million years did I think oil would be below 20 anywhere, anytime, anywhere. So, like I said, this is not natural. This isn't, God's work, so to speak. This is straight up a war. This is straight up a war of suppliers fighting other suppliers. And it's very unusual. In fact, in many countries and such, it's actually illegal. And So if you think about if you produced widgets and you have a nice little widget factory and everything's going well, and it costs you $1 to make a widget, and you like to sell them somewhere between $1.50 and $2, right? Everything's going fine, and you know your Chinese competitors also make widgets, and they also cost about $1. You have the same equipment as them and such. But then the Chinese company says, you know what? We need to take market share. So they start selling them for 75 cents. And you're like, selling them for 75 cents? It costs me more to make them than that. It costs me $1. Like, it doesn't make any sense. And what they're doing is they're putting you out of business. And when you stop making widgets, then they jack the price back up to, $1.50, maybe $2, maybe $3, because there's less competition. Okay, it's deemed illegal in many situations. So it's really interesting that, I was reading, who was it? I think it might have been Libya. Like, they're just maxing everything. So it's not just Saudi Arabia. It's sort of everyone's in the game, and I think it's because in situations like Libya or Venezuela, even if they wanted to cut production, they can't afford it. They need the money. They're like, we don't care, right? We don't care if we're selling it for $19 a barrel. We don't care because we need the $19. You can't eat oil, so we'll take the dollar. We'll take the $18, right? $75 or $50 or $35 would be significantly better, but it doesn't matter. We need the cash flow more than we need, this sticky, slimy substance in the ground. Like, dude, if you'll give us $19 for that, we'll be happy. Okay? So it's very, very interesting. Very, very interesting. Very, 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 very interesting. And like I've been saying, because this is unnatural, I don't know where the bottom is. A month ago we were talking about how I think Saudi Arabia's price is somewhere between $13 and $15, but wow, it's just crazy. That's right, Lucas. Very, very good example. He says it's like farmers. If the price of corn is down, then you need to produce even more bushels of corn to make ends meet, which pushes corn prices down even further. And then here's the next step to that, Lucas. So next year, after getting crushed by low corn prices, you decide to produce wheat. But so does every other corn farmer. So now they produce wheat. Wheat prices go down and corn prices go up. Okay, cool. So anyways, that is amazing, is all I'm saying. Amazing. Amazing. Let's take a look at South African Rand. Right now, still in a bullish move, right? See this, we're stepping up. The interesting thing is we're supposed to be higher. So if we don't breach this by the end of the day, it really sets up this way, which is a risk on move. Okay, so right now, sort of in between on that one. Let's look at all exotics, maybe come up with a risk on, risk off scenario. Okay, I wanted to show you this because Turkish lira just recently had a big move. Now it looks like it's coming back. This is a 15-minute chart. Look at that drop, huh? Check that out. Now, unfortunately, just in the last 20 minutes, it's come all the way back. But Pretty interesting move because this heading down is risk on. Okay? Remember, always mark your lines, mark your lines. So if it wants to resume now, downward move, it would happen right around here, around 7.5. So if you're a risk on trader, okay, and remember, one of the major reasons of risk on is the United States is in serious discussions about when to reopen and how to reopen. And in fact, the factories in Seattle for Boeing are reopening on Monday. I think just partially, but even symbolically, that's amazing. Because Seattle was hit really, really hard with the coronavirus. And they're like, you know what? We just need to open this factory. Because the whole city works for Boeing. I know there's a Microsoft and a Amazon and some other people there too, but Boeing's big. And so a sense of normality, or normalcy is what some people say, could be a sign for risk on for sure. Okay. Well, Mr. Hyvel, separate oil from everything. Like I said, it's unnatural. It's not supply and demand. So don't say oil down, stock market up, bullish. Oil is just oil. Oil is whatever the producers are producing. They're producing the price. The producers are producing the price. It's supposed to be the consumers that set the price. Okay, the more demand, the higher the price. Well, in this case, it has nothing to do with demand. Now, demand is down, but that's still not $18, right? So I would just simplify it then, Mr. Highvolt, and say if the stock market up, it's risk on. That's that. Because remember, there's a dichotomy. You look at the economic data, and it's horrible. But the stock market's straight up. Yeah, it's a market. Okay? It's not an economic indicator. It's a market. So what happened? Like, think of this. Like, people ignored, like, investors in the stock market in the United States ignored COVID-19 when it hit China. And it was like, oh, it's a Chinese problem. And then it hit Italy and people went, oh my God, right? And then it hit the United States and holy smokes. And what happened was people freak out. And of course, they overreact. They just totally overreact. So it took about, 2.5 weeks, and the stock market in some cases dropped 50%, depending on which stock. And then what? A week later, it was up 50%, which means it's only down 25. Now, you're like, wow, that's like crazy fast. Yeah, well, people overreacted. And then they jumped back in. Bought back in at the lower price. That has nothing to do with the economy. That's the stock market. People bought things that they wanted to own, but couldn't afford earlier. Okay? Should we be looking at risk on or risk off market or the economy? Well, typically it's the economy. Okay? Typically you're making this on economic data. But if you were going to buy, like MGM Grand is something I talked about very specifically 3 weeks ago, right? Remember when it was $8? And I said, look, if you think people are going to go back to Vegas in the next 25 years, then you buy it for $8. A $60 stock, I think it was. You buy it for $8. Now, would you look at it like, well, what's the earnings per share, right? What's the trend over the last 3 quarters? No, you're just like, oh my God, I need to buy it because it's cheap, and that's that. And there's no other economic analysis of it, right? Or there's no fundamental analysis of that stock. You're not looking at occupancy rates. You're not looking at management turnover. You're not looking at debt levels. You're just like, I want to buy it because it's cheap. Done. Okay. typically you wouldn't do that, would you? So buying it cheap because you believe it'll be around for 25 years, that's a market play. The economic analysis of earnings per share ratios or inventory turnover ratios, right? That kind of typical analysis, that'd be much more economic focused. Okay. I think it was American Airlines yesterday said the CEO said they expect all the rest of this year to be horrible and maybe even part of next year. Amazing, huh? Oh, another thing that happened yesterday, I completed my paperwork. I submitted my intent to graduate. Nice. Paperwork's in. That's big, man. That's big. You have to double check the degree. You have to double check the spelling that they're going to put your name on your degree. And like, yeah, that's pretty legit. Thank you. Yeah, boy. Well, I'm almost done these two classes. And then over the summer, I'm doing one on commercial real estate and another one on venture capital. But those are done. And those are my last two formal classes for grad school anyways. Okay, so a little dip here, but this is sort of, this still looks risk off, but there was some risk on here, right? So this is interesting. I'm glad I busted out here because this, if this rolls over, that's very risk on as well. Oh, we can look at that. But those are not exotics though. Well, not really. Like I look at them as high yield exotics. You see that, the high yield part? Okay. So I use high yield for carry trading. Thank you, everybody. I don't know, Daniel. You'll have to ask him. So like my swing trading, I focus on the trade of the week. Then my swing trading, or sorry, my main swing trading is the trade of the month. Then I teach you weekly swings, which is the trade of the week. Then I teach you daily trades, which are the trades of the day. And Ryan focuses on, let's say, London Open, for example, and how to handle the price action in the moment at that exact time. And then he'll do another one for New York, for example. And so each one of these drills in closer and closer and closer. So trade of the month, trade of the week, trade of the day, trade of the session. Yeah, the Commitment of Traders report is on Forex.Today. Baby G says the mixed mood is horrible to trade in. Yes, if you're trying to trade both. Okay? Okay? If you're trying to trade both, you're not going to love it. If you pick one and you're only sell off resistance over and over and over again, you'll be fine. So there are little tickles, little signs, little green shoots of maybe some risk on coming back to the market on Rand, on Lira, on Peso. Okay? Baby G, Matt. Yeah, take a walk. We call it going to the balcony. Go to the balcony, take a deep breath. Okay? All right. Now, so we just saw green shoots on all those exotic pairs. The reason we have Kiwi Swiss franc here is to show when there's risk off, this will go down. When there's risk on, this will go up. Check it out. Double bottom, high, 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 low, 1, 2, 3, roll reversal. Okay, hammock. So this is a classic sign now of risk back on. Now we don't know how long it's going to last because we're going to run into all of this. But nonetheless, you can just see some glimpses here in the markets of risk on. So you could look at that, say, and come up with a strategy of sell yen, for example. I'll just make that up. Sell JPY. You can look at that and say, in the near term, you're going to sell JPY because of the potential for risk on. Okay? Okay? So then you flip over to your yens. Okay? This is how you're making your decisions, guys. You switch over to your yens. We haven't had inflation for 30 years, so I'm not worried about inflation. As I mentioned yesterday or the day before, after the 2008 financial crisis and the Fed pumped in trillions of dollars in the market, I actually wrote a press release, and I think it was actually published on CNBC, about a warning about hyperinflation. So I still look like an idiot. So, right. So there you go. So I still, that's going to impact my my thought, right? Cutthroat says, I'm going to show that. Cutthroat says I look like an idiot all the time. Well, thank you very much, Cutthroat. So I'm finding some old stuff. I might have found it here. Hang on. Yeah, it's up there, David. It should be. It should be up there. I checked. It is uploaded to YouTube, which is supposed to put it in the playlist. Global. All right, hang on. May 7th, 2009. Media. Forex and commodity expert available to discuss what Fed move into treasuries mean for investors. Oh, hyperinflation is a big risk for the U.S. economy in 2010. But that could be good news for investors. Yeah. 2009, guys. March 2009. I said, look out. Hyperinflation right around the corner. Wah, wah, wah. So anyways. Yeah, so you see the login page, David? Right under the login button, there should be a video. Mr. McDonald warns traders to watch for a scenario in which the following happens simultaneously. The stock market recovers and share prices surge. Okay, I was right there. I was correct. Okay, this is 2009, guys. I'm like prices are going to surge in 2010. Okay, I was right. The Fed continues to hold interest rates at or near zero. So, okay, so I was right about that as well. Inflation skyrockets as higher share prices put money into circulation, but it loses value instantly because of low interest rates and slow economy. So inflation did not skyrocket. U.S. treasuries fall, gold prices rise. The dollar and the yen plunge. So I was right here, 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 and here, but I was wrong on inflation. Okay? This I was absolutely correct on. 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 But we didn't get inflation. Even though I was right on all those things, we still didn't get any inflation. And it's actually been one of our, conundrums as economists, right? Yeah, it's a pretty decent average, right? But this has actually been, we have economists at universities and stuff and at the Fed and at the ECB and the IMF and the World Bank. Everyone's trying to figure out why we didn't get inflation. Okay? Now, put it this way. When was the last time you put your opinion about okay, so this is March. I'm talking about 2010. So basically, I'm talking, right, a year ahead. When was the last time you published that? Right? This was on CNBC. This is the original article, though. This was on CNBC.com, I think it was. Okay. Okay. So you kind of have to know what you're talking about, right? And that's preparation. If the stock market recovers in the second half of 2009 ahead of an economic recovery, hey, this is what we're talking about today. The difference between the market and the economy. Okay? Neat, right? So anyways, sometimes you got to put it out there. If COVID-19 on crude? What would you read about that? You would, that's a demand, that specifically would be a demand side equation. So look at demand destruction. Excuse me. All right. So what did we say? Oh, if risk on, we're going to sell the Japanese yen. Okay. Oops, wrong one. Okay, that doesn't look that great. Just going to wait on that one. Okay. These are not very good markets, but there are trades there. Oops. Guess you kind of have to go something like that. Okay, so this one, to play it that way, we have to take one last drop out of the equation. Okay, and you would change this point. I guess I'll leave that. I'll just leave what we had down into that support. And then your theory, based on what you saw on exotics, now you'd look for the 1, 2, 3, and it's actually already happened. Let me redo this one. It's already happened, actually. Maybe we'll look at it on an hourly chart. Let's make this a little more accurate. Okay. That's another example of a hammock. Notice that it's exactly off the monthly central pivot, not 64,000. Instead, the monthly pivot. Okay? And notice that it went a little bit below. That's to cover the spread. Okay? Yeah, it was fun, Ed. Maida even put on a sport coat. I think pearls, too. She looked great. Got all dressed up for it. So that's how you play that if that was your theme, if that was your theory, if that was your strategy. And then you see something very similar here, although on a different time frame. Let's go back into here. You can see we already have it set slightly sloped. Remember, we're talking about how to follow up on a change in direction in commodities as a sign of risk, going from risk off to risk on, up, 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 down, down, and then this is what you'd be playing now if you're risk on. Okay. Yeah, Fury, if you want Commitment to Traders report, it's on Forex.Today. That's right. You definitely had it. So news trader, if you're risk on, then Dixie DXY would be down. Okay. Daniel, you need to know all of them. Daniel's asking, like, how do you make the most money as a trader? You scalp, spot, spot, swing, both monthly, weekly and monthly, right? Day, swing, and position. And part of position trades are carry trades. So I'll even put that down. Okay. You do it all, man. That's how you do it. You have to do all those. Now the interesting thing is I scalp into my spot. I spot right in my day. Day trades turn into swing trades turn into position trades, and if they offer a yield, I capture the carry. Okay. Spot is what I mean. So spot means on the spot. That's what it means. It's actually, right, it's actually a term. So a spot trade means I'm making this trade now, and I'm making it on the spot, meaning my entry and my exit's going to be within, let's say, a market. So between 4 and 8 hour trade. So let's say I sell at the London Open, right? So a spot trade, you would exit either at London lunch, which is New York open, or London close if it's a big trade, which is, right? Which is the US lunch. Okay? So that's on the spot. You're not thinking about tomorrow. You're barely even thinking about the rest of the day. You're just selling it, and you're going to exit somewhere between 1 and 8 hours. It's not even a day trade. Okay? Yes, exactly. Okay. Now, going back to Commitment of Traders report, first of all, the data you look at is released on Friday, so I wouldn't look at it today because today is Friday and we get new data released at 4 p.m., I think it is. So you couldn't get any older data than right now. Okay? So tomorrow morning, while you're having your cigar and your cup of coffee, and you got your dog at your feet, and the birds are chirping, you can go through your Commitment of Traders report. So you can go to Forex.Today, click on COT report. And in my opinion, it's the best one out there. No, scalp is, no, a scalp is a scalp. A scalp is a very, very short-term trade. You're not typically in a scalp more than a few minutes, but maybe an hour if it's a slow scalp. But I think scalping is actually somewhat dead, and so, that would anger a lot of people, but they haven't been trading for that long, so they read some guy's book from 10 years ago, and now they're scalpers. But what they don't understand is I used to scalp like 40 pips in like 8 minutes. Now 40 pips, even with crazy, ridiculous news on like non-farm payrolls, that's a good day. that's 4 hours of trading, not 8 minutes, right? And non-farm payrolls, when I was scalping news, we'd pick up 200 or 300 pips in a non-farm payrolls, in a non-farm payrolls thing. And now, I mean, it only moves 40 pips, and the whole kit and caboodle is only worth 40 pips. You can't make 300 pips scalping non-farm payrolls, right? So, like, really, honestly, it's dead, right? But lots of people do it because I guess they heard the stories and it sounds exciting, and they read old books about how scalping is all, it's all about scalping and all that kind of stuff. Well, yeah, when you could make 500 pips a day scalping, it was legit. But now you can't even make 100 pips a day most likely. So it's just old news. It's boring. But what I do is I still use the same scalping techniques to enter my trades, but I look at it as more of refining my entry. So if I want to sell at resistance, I'm looking at the resistance on a 1 minute chart or maybe a 5 minute chart. So then when I get my trigger to pull the trigger, right? When I get my sign, I go sham, pachow. And it's very, very close to that resistance because I'm scalping in at resistance, which is better than a 15-minute chart, which like takes 2 hours to confirm. A 1 minute or a 5 minute chart confirms much, therefore I'm closer to the resistance, or I'm buying much closer to support. But it's still not truly a scalp, because if we're in the live trading group, right? We talk about being embarrassed if you make less than 100 pips. If you make a trade and you don't even get 100 pips, like, it's truly embarrassing. You clearly didn't have a trade plan, or your trade plans are just not worth very much, and we need to work on that. Okay? All right. So anyways, going back to whoever asked about the commitment of traders report, this is it right here. But we get new data this afternoon. And so what you're looking at now is data from last week, Tuesday. And by tomorrow morning, you'll look at the same chart and it'll be updated one tick, and it'll be this week, Tuesday. Because institutional investors and institutional hedgers, they come to work on Monday and they do all their Monday stuff, but they know by Tuesday they must submit their large institutional positions to the Commodity Futures Trading Commission. It's due Tuesday. So they work on it Monday, they submit it probably Tuesday morning, and by the close of trading on Tuesday, the CFTC has the data from all the bona fide hedgers, from all the large institutional investors. They take data from the exchange so that they know the total volume. From that, they can do the math to figure out the non-institutional, aka dumb money positions in the market. They can all be extrapolated. It's not that complicated. And then they compile all that data and they release it Friday at market close. Okay? So it's lagging, but it's important to know extremes. Okay? So when the market is unbelievably bullish on one or unbelievably bearish on a different thing, and then you see a turning point, it's a pretty big piece of information, right? The other thing I like about the COT data is that it explains if buyers are buying or if buyers are not buying. So, for example, this euro, because we're looking at euro right now, there was a time when the euro dollar was going up and up and up and up for weeks and weeks, this huge rally. But I used the Commitment of Traders report to show everybody nobody was actually buying the euro. What was happening is for many, many weeks and many, many months, investors around the world had bought the US dollar. And something changed. I forget what it was, but something changed. And everyone was getting out of the dollar long position. So they were short euro dollar. And what was happening is all the shorts were being squeezed out of their trades. Everyone was exiting euro dollar short, which made the euro dollar rise. But then I showed, look, as far as positions of buying euro, no one was actually buying the euro. Nobody wanted the euro. They were just exiting their short, which means to get out of their short positions, they have to go long, which offsets their position. So anyways, it was rising, 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 and it was much more dollar weakness than euro bullishness. And I could show it that there were no traders were by and large not purchasing euro, but euro was ripper strong. And not just for a few minutes, for a few weeks. And it was just money going from the US dollar long back to Europe, and then of course, and then any funding had to be paid back. So that kind of information is really good, because then I posed this question. I said, okay guys, if we know there were massive long dollar positions and now they're all being unwound, what's the likelihood that sometime in the future those same investors are going to come back in the market and want to buy the dollar again? And everyone's like, yeah, probably pretty high, considering that no one's actually buying euro. So at some point when the dollar weakens, it'll be a good opportunity to get back in and do what they did last year and make that kind of money again, right? And everyone's like, yeah, that makes sense. And I'm like, well, we know this is helpful. You know, having the COT data was helpful to come up with that general strategy, knowing that there were many dollar bulls. All those dollar bulls were taking profit, and that sometime in the near future, probably in the next upcoming few weeks at that time we were talking about, that those dollar bulls will probably want to buy dollars again. And then we could sit around getting ready, looking for the sign. And the sign would be key psychological level where they would want to get back in, maybe key monthly pivot level where they might want to get in, or something to that effect. or maybe a change in policy at the central bank, something like that. And now you can base a strategy. And now imagine talking to your client. Well, you can say, well, there's this, this huge dollar position that's being unwound. So you're avoiding that right now, but you believe in the near future, those dollar bulls are going to return to the market and start buying, and you're going to look for those signs and get in with them in the early days and ride it out for weeks and even months. And you're like, oh, and they're like, that makes sense. Okay. So there you go. So every Friday or maybe every Saturday morning, visit this page. It was the Fed dropping interest rates and interest swaps and no more. Yeah, maybe. Sure, Bob. Cool. Hey, Bob, when we hang out in Boston, are you a cigar guy? I'm like a broken record, right? But look, there's only one cigar place in Boston. We can go. Ferry says, thanks for sharing. Oh, my pleasure. It's why I'm here. Yeah, David C. When I'm trading London, I usually get in no later, let's say, than an hour and a half before the London Open. 1:30 a.m. New York time. Boston. Stanzi Cigari is all I'm saying. Next time I'm in Boston, maybe we can meet up there. Yeah, we looked at that hope at like 18 and some change. Holy. Paktika and Harvard Yard. Do London boys trade a bias? Well, everyone trades bias. You have to have an opinion. Why would someone pay you money if you don't even have an opinion, right? But the second thing is, right, all traders, but especially London boys, for example, they want to buy low or they want to sell high. But you have to have a strategy. You guys have to understand you cannot raise money if you don't have a strategy. In fact, you have to have a strategy. It has to go into the disclosure document. And if you don't follow the strategy and you lose money, your clients will sue you. And you'll lose your license. New Trader says Dixie wants it to drop. Yeah, well, like we showed, like I just spent a half an hour looking and explaining, there seems to be some green shoots for risk on, and risk on would lower the Dixie. And I actually wrote it in marker that would be the likely scenario. We just don't know if there's going to be a risk on, so you have to look at the signs and make your decision. Let's go back here. Let's look at Bitcoin. Hey, Anthony, I got your emails, and no blood, no foul, man. But the video was supposed to be up there, so I uploaded it and added it to the playlist. So if you look now at the login page, you'll see that there's a playlist under it, and that's where the video is now. Heard you doing Bitcoin now. Hey, Ma! How you doing Bitcoin now? Sure enough. Yeah. Pip Cyborg. He doing Bitcoin. Yeah, cool. Hey, Ma, put your teeth back in and come take a look at this. Oh, yeah, the meatloaf one is even funny, right? Yeah. What's she doing? What does she do? Well, that friend of mine, we've been talking about it. So I had him look at the halving issue and stuff like that. But I told him, I said, look, next time you buy $40 million worth of Bitcoin, you should give Uncle Wayne a call, right? Give Papa a call. I can't go by Uncle Wayne anymore because then I sound like, what's his name? Cardone. So I gotta be the professor. Talk to the professor first. Okay. So up if it's risk on. Down if it's risk off. So understand that there's only one risk on or one risk off. Okay? So when you make a decision based on global macroeconomics, you say risk on. Everything is going to get better. We've been through the worst. COVID-19 2020 has come and is now passing. And it'll be in the rear view mirror not long from now. So in 8 weeks, most restaurants in America will be back open. The waitress can work at Applebee's again. Meanwhile, she got a $3,000 check from the government, and so anyway, she's back to work, and people rush back to the bars, people rush back to the restaurants, people rush back to the movie theaters, and boom, bada bing, bada boom, we have a full recovery. Done. So if that's what you believe, that's your belief. That is a bias. That's what we're looking for. That's what you need to explain to clients, what your opinion is and why you think it. So if you're risk on, this is very, very easy stuff. You sell the US dollar against everything. In particular, against things that happen to be strong today or this week. Okay? You sell the Swiss franc against everything, and particularly things that are strong this week. You sell the Japanese yen versus everything, and particularly against things that are strong this week. And things like Bitcoin. Bitcoin goes up. Things like oil goes up. So on and so forth. All based on one decision. One decision. That you're like, the worst is over, things can only get better. Done. Okay? You see what I mean? So, if that's true, then you think, if the worst is over, see, this is when things are bad. Remember that? And then what? Now things have improved. So what do you believe? You believe this is what's going to continue in the near future. That you're saying that's what the next week will look like. Something like that. Fine. Risk on, oil goes up? Yeah, of course. Absolutely. Cool. Thank you for subscribing. I appreciate that. Welcome to the family. Okay. And it looks like I got knocked out of those two trades. One for break even and another one for what was it, 50 pips? So cool. So HH says Grant Cardone Capital filing for bankruptcy and stuff. So, so he's a syndicator. And if that is true, which I don't know if he's filing for bankruptcy or stuff, but the only way that's true is if his properties, which are filled with renters, like you have to think of what a syndicator does. Okay. So you bring in other people's money and you buy some property. That's all it is. Pretty simple. It's very similar to a venture capital model where general partners go out and they have a strategy. They want to buy a certain type of startup, right? They want to invest in certain types of startups. So they go and they bring in limited partners that put in the money, but they're limited. They put in the money, they get some reward at the end if it's successful, but they don't really participate in picking what startups get funded and which ones don't. They're limited. But the general partners do all that. They do all the work. Limited partners get a big piece of the pie. Great. So you go out and you make investments. In this case, if you're doing a real estate in syndication model, just think of it as a venture capital fund that instead of putting the money into startups, you put the money into real estate. Cool. So now the manager in charge of the money makes decisions on like, how much leverage do you use? Okay? You understand? So you make a decision, how much cash do you put down and how much do you borrow? Now, what do we know about leverage, guys? As currency traders, what do we know about leverage? See, when you, in the beginning, you buy these assets with lots of leverage. And what happens is because you have such little amounts of money in the actual game, right? That any kind of return makes your percentage look great. Right? Right? So you put in hardly anything. So any kind of cash flow that comes to you, you're like, I made 1,000% return on investment. Why? Leverage. But if you had twice as much, now you only had 500%. And if you had twice as much as then, right? And then you'd have even less and less. So that works really well when cash flow is steady. Okay? But crises always exposes bad investments. Okay? The only people that lost money in the stock market are people that bought the stock market in the last 2 years. Do you understand that? My friend, he and I, we were talking a couple of weeks ago, and he's like, I lost so much money in the stock market. I'm like, no, you didn't. He's like, well, what do you mean? I'm like, did you cash out at the top? No. Well, then it's all just paper money anyways. It was all fake to begin with. I said, all the money you made in the last 2 years in your stock market portfolio, it was BS anyways. You're right? People were buying Apple at 27 times earnings. That's stupid. It's dumb money. And if you were smart about it, you would have cashed out. The funny thing is, his wealth manager didn't even cash him out when he said he should. But anyways, so I'm like, so it was all phony baloney anyways. And he's like, yeah, okay. And I'm like, it'll work itself out. Just if you want to get back into the stock market, start picking new things, but don't worry about those old deals. Now, if you bought Apple at 27 times earnings, you lost money because you bought last year or the year before. And all of that money went away over the last few weeks. Well, you paid too much. It was a dumb idea to begin with, and you lost it. Too bad, so sad. Should have used a stop loss. Okay? So we know timing is an issue, and we know leverage is an issue, right? Okay? And so in that situation where if your cash flow goes away and you lose money on your real estate, it's because you are living completely off the cash flow. So like, put it this way, if you put 50% down, right? So typically with commercial real estate, you put 30% down, right? And with personal investments like single family homes, you would put 20% down, right? Well, if you put 50% down, you would have significantly less leverage than a typical real estate investor, right? But what that means is your mortgage is tiny, minuscule. But if you have like let's say no money down, your mortgage payment is huge. Okay? Yeah, the LTV. So anyways, if Grant Cardone is going bankrupt on his, what, $2 billion, he says, of real estate, it's because he must have been incredibly leveraged. And the way you do it is, and here's probably what he was doing. He got a bunch of limited partners to go in with his firm, the general partnership, and that would be called Cardone Capital. So, okay, great. So what happens is Cardone Capital opens an LLC. They make, and they're the general partners, and then they find an apartment building to invest in. So they create an LLC to buy the apartment building. Limited partners own shares, general partners own shares. Okay, and this LLC owns this, right? And then they do this 2 or 3 or 4 times. And then Grant Cardone now has a whole bunch of these deals, which now he can leverage and do his side deals. So now he does a side deal for himself. He does a double dip side deal, which means maybe he has $500 million in real estate, 105 different deals worth $100 million each. Then he can go to a bank and say, well, we're the general partners on a $500 million portfolio, which we control. I would like to use that to leverage a new deal. And now he gets deal number 6 for himself. He could do that. I'm not saying he did, but he probably did. But somehow they put almost no money down, hardly any money down, money down, which means he's highly, highly, highly leveraged. And if he suddenly goes from 4% occupancy rate, that's a percentage, to 8%, vacancy rate, he can't afford to pay the mortgage. That's it. That's it. He's out. He can't afford it. Can't even pay the mortgage. And you go bankrupt. Because now you need to, like, every single month come up with, let's say, he owes the bank, he has some cash flow, but let's say every single month he owes, I'll make a number up, 58M. Right? And you're like, whoa, dude, because it's 8% or whatever, and the loss of rent on 8% of a $2 billion portfolio, but almost all of it is leveraged up the yin yang. You could screw it up. Just like a currency trader could screw up their trading with too much leverage. Do you understand that? Right? So notice, like, with a $30,000 account, okay, I can own a $3 million portfolio. Do you understand that? So I could drop 20 standard lots on a trade. What do you think? Good idea? And then I could say, boom, I own a $2 million portfolio. And you're like, dude, you only have 30,000 in cash. Yeah, but I own $2 million. Like, dude, you only have 30,000. Why would you? But I'm like, I got two. That's the problem, right? I own $2 billion worth of real estate. But you are leveraged like crazy, dude. Holy smokes. Right? But do you understand? Like a currency trader learns the hard way, right? And that's why we have demo accounts. Okay? Yeah, so what happens if the market moves 3% against me? I lose my 30,000. Now I'm crying, right? So it's funny, like, the only reason Bernie Madoff got caught with his scam was all the credit markets freezing, banks blowing up, and this black swan event. Well, we've had another, you could call it a black swan event, I guess. But what it does is it exposes people that have made bad decisions. Okay? So if you owned $2 billion worth of real estate and you were conservative when buying them, so you spent at least let's say, what did I say, 3 billion? So if you own 3 billion in real estate, but you have 1.5 billion invested, your leverage is very, very low, and a change in occupancy rate kills your cash flow, but you don't go bankrupt. And by the way, in 10 years, what's your $3 billion portfolio going to be worth? 7 billion. So like, why would you want to get knocked out, right? Like, why would you leverage up? Well, you can't afford the 3 billion. But trading is the same too, guys. If you can't afford it, you shouldn't be in it. Okay? So if he'd taken the same amount of money, whatever that money is that he raised, and instead of owning 2 billion, he only owned 1 billion, he'd still have $1 billion in real estate and he wouldn't be filing for bankruptcy. He'd still be collecting rent every month, just a little bit less. Okay? So if you want to go in and buy his real estate now for cheap, let's do it. Okay? So anyways, in the near future, I'm thinking next year, in 2021, I'll put together a real estate course for you guys. Not house flipping nonsense, though. I'm going to teach you how it relates to money and how money works. So I can see right off the bat, we need to talk about how does one decide on a rent? Okay? If you have a corner store, right on the corner, and the sidewalk goes this way and that way around the corner. Now I know you have to think three-dimensionally on that, but anyways, it's a sidewalk. Okay. And here's the window. Okay. What kind of store should you put here? A mattress store where you can buy yourself a nice Tempur-Pedic, or do you put in a Starbucks? You own this real estate. You own the building. What kind of tenant should you lease this to? And Ron, would they pay the same rent? Or an Apple store? But do they pay the same rent? Okay. So it's an interesting discussion of why that is and how it works. Okay. Another example of this is here's a farm, here's a farm, here's a farm, and here's a farm. As far as yield, this does 8 bushels an acre, 6 bushels an acre, 3 bushels an acre, and 1 bushel per acre. Figure out the rent. Oh, and part of this equation would be, or you work in town and you make $12 an hour working at Starbucks. So you can be a farmer, 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 or you can just move into town and work at Starbucks for $12 an hour. You can actually figure out the rent for all of this. And of course, you have to say a bushel is worth 200 bucks. So what is the rent? So we will go all the way back in time to Ricardo. Okay. We'll start with the corn laws of the English Civil War, I think it was. Okay, so we'll go back hundreds and hundreds of years and explore rent through economics. That's how I would do a real estate course if I were me. Cool. So anyways, it's Friday. I'm tired, man. I'm tired. Oh! Is there anything else I can do for you? Yeah, Adam, 8.5 spread. You know, there was a time several years ago when there was zero spread between WTI and Brent. And I told everyone, I said, you may never see this ever again. Zero spread. They were the same price. Pretty interesting. Yeah, we did oil like first thing. But look at it now, guys. It's 17. Like, it's unheard of. So where's the bottom? You know, I don't know. It's not, it's like I keep saying, this is not a natural price. This is not the equilibrium between supply and demand. This is all human created. Okay. Yeah, the group will meet Sunday at 5 p.m. Aussie dollar. Okay, we can look at Aussie dollar. You are not alone. Pure mathematics is oil is a good buy for long term, but the problem is you can't hold it. The negative carry is so great that it's not really something you would hold long term. But you could, I mean, at some point it has to go up, right? You'd think. So it's great for day trading. Okay. So, anyways, guys, this is Aussie dollar. If you're taking it this way, you had the 382 last night. There's support around the 50%, as you can already see. If you're a bear, you're kicking it off the monthly, which is this. This is great. I should make that black, though. It's confusing because the central's black. So let's do it this way. Okay. So this is resistance. So if you're a bear and you want this to come down, that's risk off because you're buying USD. And it's going to look like this. You're going to sell it off 64 and you're going to take it down to here anyways, which is 62. So there's a couple of hundred pips into it if you got it right. Well, they're different oil. Alexander, right? They're different oil. One comes out of the ground in Texas. The other one comes out below the North Sea. So the North Sea oil is more expensive. One way of looking at it is WTI is American oil, and Brent is, people say international oil, which I don't really, I'd call it more like European oil. And which is, and I only say European because Norway gets to benefit from their exposure to the North Sea. But like, there's no oil in Europe unless you're throwing Russia in as European, but most of Russia's east of the Ural Mountains, right? So Moscow doesn't have oil. So anyways, if you're in Europe, you get your natural gas through pipelines from Russia. Okay, there's no natural gas or oil, or not enough, not nearly enough, in Europe itself. Now, I argued several years ago at Harvard where Europeans should cut all their ties with the Russians, cut off stop buying oil and natural gas from Russia, and instead develop relationships with Africa and pull it north instead of pull it west, and kick the Chinese out of Africa. But the Europeans can't do that. And one of the reasons is they say, well, we will only work with the Africans if we pay them European wages, and we can't afford that, so we will just go ahead and buy it from Russia. And the Africans are like, whoa, whoa, whoa. We're not asking for $50 an hour for our employees. Like, we'd love to sell you oil at good African prices, right? And the Europeans are like, no, that'd be socially unfair. And so they just rather not buy any oil from Africa, which is, if you think about it, worse for Africa. So anyways, so the Chinese are going in offering to buy oil from Africa for half price, but they'll throw in a train station and a new airport, but for a commitment to sell cheap oil to the Chinese for decades. And by the way, all the employees are Chinese, so no one in Africa gets the construction contracts and all that, and all the employees pulling the oil out of the ground are also Chinese, so none of the Africans benefit from increased skill or something. They're just selling their resources for cheap. They should have sold it to Europe, but Europeans are stuck in their socialist mindset. I'm not saying it's negative. It's just a socialist mindset. And so instead, they send all their money to Russia, to Vladimir Putin. So it's an interesting scenario. But Brent is North Sea oil. So half of it goes to the UK, the other half goes to Norway. Boss says, yeah, the French didn't pay anything for Gabon. Yeah. Yeah. I don't know, Ed. Maybe. So yeah, so it's very, very, very interesting. So, for example, the best oil in the world is from from Nigeria. I had Cameroon stuck in my mind. From Nigeria. Nigerian oil is beautiful, light, sweet, gorgeous oil. Gorgeous. Guess where the Americans built their their naval command? Oh, right off the coast of Nigeria. They're like, this is our oil. We're going to park all our Navy ships right here. Right here. This is our oil. Naval Strategic Command for the whole region. Right next to the best oil in the world. Yeah. This was back in the day when oil prices were super high and Americans didn't export any oil. They had to import all of it. So they're like, well, we buy a lot of oil from OPEC and particularly Saudi Arabia, maybe we should lock up this whole, this whole oil thing with Nigeria, right? And of course, Angola is right next to it, right? And that's why when you go to Beverly Hills, you see like the president of Angola's son rolling around in his purple Lamborghini, and naked girls at the swimming pool, and I don't know, living in crazy debauchery. Like it's all that Angolan oil. Boom. So lots of good oil in Angola and Nigeria. Is that right, Baby G? So yeah, it looks like something didn't go well. So I will take a look. Okay. Well, Gary, W. Arthur Lewis, I don't even know if he's still alive, but he'd be an old man. So be careful, these things change too, right? Well, I don't know, Alexander. Yeah, I was going to say, so if he wrote that 90% of African commodities are sold to the USA and Europe, you got to be careful. That's really old data. There's China, for example, has gone in and has done deals with government leaders to say, hey, we will make you filthy, stinking rich. Number one. Number two, we will build you a beautiful airport and you can name the airport after yourself. And three, you're going to sign a contract to sell us oil for cheap for decades and decades and decades. But bear in mind, I will personally make you filthy, stinking rich beyond imagine. And two, we'll build a beautiful airport for you and name it after you. And three, you're going to sell us billions of dollars worth of oil for millions of dollars. And they're like, okay. And that's been going on for a while now. And that's very, very, very dangerous. And like another example, back when oil prices were like $150 a barrel, and the Western world put an embargo on Darfur because of how bad things were in Darfur at the time. The Chinese went in and said, okay, oil's at $150 a barrel. Americans, Canadians, Europeans, like no one is buying your oil. No one's buying anything from you guys. So we will buy your oil not for 150, not for 120, not for 100, not for 90, not for 80, not for 70, not for 60, not for 50 or 40, but for $30 a barrel, we will buy all of it. That's what the Chinese did. It worked out really good for the Chinese. So anyways, these things get complicated when you mix in politics, is all I'm saying. So I will go check the playlist, guys. I apologize for that. So I'll see what went wrong, see what I need to do to fix it. I'll do that right now. Okay? The Chinese are building hospitals and toll roads in Jamaica. Yeah, for altruism? What do they get? In exchange, right? What do they get? So anyways, peace on earth. May the pips be with you. May your profits be above average. Have a lovely weekend. Thank you very much for everything. Men in action, you'll have to figure that out. What does it mean? You'll have to figure it out. Why such an exact number? Because that's how I roll, baby. That's how I roll. The links are in the video description below, guys. Look at the description below the video. Cool. Thank you, guys. All the best.